Okay, well, welcome everybody again to today's webinar. My name is Alex, and I'm going to be hosting today's session. Again, my name is Alex. I'm the head of support here for Aplos, which means I just kind of help coordinate the team that allows you to helps you learn the software, as well as provides training on accounting, as well as our software helps you troubleshoot any issues that you're going through, helps with setup. All of that is within the support team, which I have the privilege of being a part of. So that's what I do here with Aplos. And for those of you who are new to Aplos, we provide online software for churches and nonprofits, specifically accounting and donations management software. So if you're in the market, if you're a small to medium nonprofit and you're in the market for accounting or donor management systems, look no further. We are here. Today, what we're doing here today is a little bit different and pretty special. We do weekly webinars that go over how to use Aplos, how to do stuff in the software, but a lot of our customers were letting us know that they really wanted a more detailed understanding of accounting. So what are the accounts? Why do I use the register and not journal entry? What is journal entry? What is double entry accounting? So all of that is going to be covered here today in our topic. So what we're doing is taking a look at journal entry. We're going to take a look at the different types of accounts and how they work with one another, as well as what double entry accounting means in relation to single entry. And then we're going to take a detailed look at journal entry, and I'm going to show you a lot of examples of transactions on what are how journal entry is used, when you would use it. And then for you Aplos specific customers, I'll also tell you when you're not going to use journal entry and when you would use one screen over the other. And as we go through this, there is that question field that you guys found just a little bit ago. If you have questions now, during, or even after my spiel, feel free to type those in, and then I'll do my best to answer everything in a little Q&A time at the end. All right? Alrighty, well, let's get started. So the first thing I want to cover here today is accounts as a very high-level overview of what accounts are, and then we'll get into how they work with one another. Now, just kind of as a disclaimer, if you are new to accounting, I will do my best to make this as slow and as easy to understand as possible, but it's possible that you might need a little bit more foundation before really grasping on to today's topic. So if that's the case, I can point you to different resources which has that, but here we go. Okay, so for those of you who are relatively savvy with accounting things, you know that there are 5 different types of accounts. The first one is called your asset. An asset account is an account that you create in an accounting system to represent anything that you as an organization own. O-W-N, own. So this, at the most basic level, can be an account to represent the money in the bank, so checking, savings, petty cash. This can also be money that is owed to you, but you haven't received yet, which is what's called an accounts receivable. But really an asset is for anything that you own. So it can be land, it can be building, it can be stock, it can be equipment, it can be receivables, it can be anything that you own as an organization. So that's an asset account, all right? And then you have liability accounts. Liability accounts are anything that you as an organization owe, O-W-E. So any money that you pay someone else, that you owe someone else. So examples of this could be money that has been billed to you, but you haven't paid yet, but that's more kind of a shorter term liability, also known as an accounts payable. You've also got credit card balances. So when you record transactions onto a credit card, that's you buying things with the credit card company's money. And so then you owe them, your credit card bill. So that is considered a liability. This can also be accrued things that you kind of build up over time that eventually need to be paid out for whatever reason. So accrued fees or interest or vacation or accrued payroll taxes, that kind of thing. As well as long-term debt. So if any of you are homeowners out there, you've got a mortgage most likely that you owe for your house, and so that's more of a long-term debt. But all of that money that you owe somebody else is a liability. And then we have equity. Now, equity is a little special with Aplos and with fund accounting. With a business, equity is retained earnings. It's stockholders' income. It's also, stockholders' shares and equity. So it works a little bit differently for businesses. For fund accounting, what equity is your fund balances. Okay, it's your fund balances. So in Aplos, let's say I have 4 funds. I have a building fund, I have a general fund, I have a missions fund, and I have a special projects fund. Okay, these are funds within my organization. Which, for those of you who might be new to what a fund is think of your whole organization as a circle. It's like a pie chart. Okay, if you were to divvy out little slices of the pie, and each slice is its own thing, it's its own entity, it's got its own income and expense and balances and debt, that is a fund. Okay, so fund accounting allows you to track these funds. It allows you to track their balances, the debt that you have against them, the income and the expense, all different types of transactions for each fund, and then the sum of all of your funds equals your total organization. Okay, so that's a fund. So for each fund that you create, we create an equity account for that fund balance. So when you look at your balance sheet, you can see your assets and your liabilities, and then your total fund balances, which are the sum of all of your fund balances within your asset and liability accounts. All right. So income is next. So income and expenses are what you use on a more daily basis. So income is an account that you would create to record the reason or the avenue or basically why anybody's given you money or however you've received money. So if you've received money in a certain way, most likely you want to create an income account for that. So you can see I've got a couple here: contributions income, grant income, missions income, fundraiser donations. So each account is set up specifically for a different way or reason why I get money. So any way you receive money, income account. Expenses, the exact opposite. Any way that you spend money. So money that is not owed necessarily, but money that you've spent. So you go to the store and you buy office supplies. It's an office supplies expense account. I've got salary and wages. I've got payroll fees, payroll taxes, alarm service, copier lease. All different categories of why I spend money are all created as expense accounts. So those are the 5 different areas of accounting, 5 different types of accounts. Assets, again, anything that you own. Liabilities, anything that you owe somebody else. Equity is your fund balances in Aplos and in any fund accounting system. Income is ways that you receive money. Expenses is ways that you spend or pay money. Okay? So those are the different types of accounts. Now, these all work together in a very special way when you record transactions. So let me give you kind of a brief overview of what single entry accounting means. Single entry accounting is, let's say you've got a piece of paper and you say that I went to Best Buy and I spent $50. Okay, that's single entry accounting. All that is you recording I spent money here for this reason. It was $50. That's it. It's one-sided. Double entry accounting is what Aplos and any accounting software out there, most likely that you're going to use, does what's called double entry accounting, which means that for every transaction that you record, there's always at least 2 sides to the equation. So that $50 that I spent at Best Buy, that's great, okay, but that $50, where did it come from? Is that on a credit card? Is that out of my bank? Is that money I stole out of my friend's wallet? How did I get that money to pay for that Best Buy purchase? If you're using a double entry accounting system, you've got something that looks like this, which is your register. So the register here is what we have. It's otherwise known as a general ledger, but this is basically where you would pick what asset or liability account that you're working with. So let's say my checking account, and then you would record the $50 that you spend at Best Buy. So what this does is you put in here, I bought supplies, and I spent $50, and I didn't write a check, but this is coming out of my office supplies expense account, out of my general fund. So that right there is the version of single entry, but what makes it double entry is when you record this, it's saying, okay, that money's coming out of my checking account. So when I click submit, it not only records $50 using my expense account, but it also records $50 coming out of my checking account. Hopefully that makes sense. So double entry, 2 sides. That's what we do. Now, I'm going to turn you on your head here. So every transaction ever recorded in Aplos or in any accounting software is a journal entry. Okay? The journal entry is the standard double entry format to where you would enter both sides of these transactions. This is done through using debits and credits. Now, people who have taken an accounting course, 20 years ago are starting to cry a little bit at the mention of debits and credits because it is a weird topic and it doesn't follow any normal logic. Because when I first started getting used to accounting and when I started with Aplos, I knew nothing. So I looked at this screen and I said, okay, debit and credit card. Okay, so I need to record my debit card purchase here and my credit card purchase here. Doesn't make any sense. Don't get too hung up on the words debit and credit. That means nothing. All that is left and right. It might as well be apples and oranges. The words debit and credit don't mean anything. But debit represents one side of the transaction and credit is the other side. Another kind of rule of thumb with accounting is all transactions need to be in balance. So debits will always, every single time, debits will always equal the credits when you record a transaction, okay? We'll take a look at that here in a second. So how does that correlate with what we've been talking about? So I've got a journal entry here. This is how I record a transaction. This is where I can record any type of transaction. So then how do I do that? How does that work with my accounts? Well, I have created this little chart here as a cheat sheet, okay? So this is the relationship of all of your accounts and how they work together with debits and credits and with one another. So first, you've got your assets, okay? Then your liabilities, then your equity, your income, and your expense. Now, if in your head, if you can memorize this chart, then entering any transaction from here on out is going to be self-explanatory. So here we go. So let's run through an example. So let's say that you are recording that Best Buy purchase, okay? So I'm going to go to Best Buy, spend $50. I'm using an expense account for office supplies. There's my expense account. I'm going to record this. I am increasing my expense account, which means I'm adding value to my expense account. So I'm increasing that, which is done through a debit to my expense account. Remember the other side of the transaction. I spent money out of my checking. What is my checking account? It's an asset. So therefore, my asset account right here is being removed of $50, which means that that is a credit. Okay. So if I was going to record a journal entry to show this, I would have a debit of $50 using my expense account, and I would have a credit of $50 using my asset account. Debits equal 50, credits equal 50, they balance. You can post the transaction. That's a journal entry. That's it. So for any type of transaction, this is the relationship. So assets are increased. If you're going to increase the value of an asset account, it's increased by a debit and it's decreased by a credit. The other type of account that increases and decreases the same way is expense. So assets and expenses are both increased. If you want to add value to them, it's done through a debit. Everybody else, liability and equity and income, is all the complete opposite. So those are all increased by credits and decreased by debits. Okay, so let's do an example. So let's do another simple income purchase here. So I'm just going to minimize this for a second here. So let's say that today I'm going to receive a contribution from Alex. Okay. I'm going to donate money to myself. So what this is happening is I'm going to record that I'm going to pick one of my income accounts, so contributions income, and this is going to go into my, let's say it's the missions fund, okay? So now what do? Okay, so I've got my income account, I've got my fund, so I want to add value to my income account, so therefore I'm going to record the $100 donation as a credit side, okay? Go away. Okay, so $100. So there we go. So there's the $100 in the credit side. Now, where is this money going to? I just got a check for $100. That's great. Where am I going to put it? Let's say this is going into my savings account. So I'm going to pick my asset savings account. I need to pick the exact same fund as the income. So I'm going to pick missions fund. And so now I need a debit. Well, savings is an asset account. So if I'm going to put money into it, it's going to increase my asset account. So therefore, it's a debit value. Okay, so there's the debit. So I get $100 for my income. That $100 goes into my savings account, my asset. Everything is in balance. You'll notice there's no red text yelling at you or anything. And I can now click post. So once I click post, that now saves to my transaction list here on the left-hand side. So if I click on that, I can see contribution from Alex. Here's a savings increase of a debit for $100. Here's a contributions increase for $100. And there we go. So there's my balance. Now, if I were to go to one of my reports and go to, say, my income statement, that contributions income has been raised by $100, and my balance sheet has been given $100 in my savings account as well. So journal entry is where you can record any transaction you want. It is the full unbridled double entry screen of Aplos. Now, we'll go through a couple of other examples, but I want to make a clear distinction here for you Aplos users out there on why you don't use journal entry on a daily basis. One, it's confusing, and I don't feel like teaching everybody. Journal entry is a more advanced tool. So, and it's not very simple. I mean, we had to go through a whole webinar just for me to express what this means. So what we've done is we created other screens, and other softwares do this too, that make transaction entry simple. So the register. When you go to your register and you pick the register account that you're working in, based on the transaction that you enter, we know what the other side of the transaction is. For instance, the $50 that I put in for Best Buy. So you recorded $50 using your expense account of office supplies. Okay, there we go. Also, because my checking is selected up here, we know then that if I'm going to increase an expense account, that means that the asset needs to decrease. So there you go. So that would record that. If you're working with, say, a credit card register, it would be something very similar, but it would be using a liability. So it would be an expense of $50 made on my credit card. So I'm now increasing my liability balance for my credit card. So then that equals that right there. So there's the credit value. Something just also of note, plus and minus doesn't mean positive and negative figures, okay? It's completely different. All it means is that it's increasing or decreasing the account type, okay? So you don't have to have a negative and a negative. You can have a positive and a negative. Does that make sense? Okay, so there we go. So the register makes transaction entry easier for anything that impacts one of your register accounts, most typically asset and liability accounts. Other screens like accounts payable. So accounts payable, you do something very similar. You're going to enter a new bill to your payable liability account, but then you enter the expense and what you owe, whoever you owe. So what you're doing is you're entering an expense that I owe somebody for some work that they did, and I'm increasing a liability balance. So then when you pay the payable down here at the bottom, right there, pay the payable, you're actually decreasing the liability, and you're decreasing the cash account that you're paying the liability with, okay? Again, see, every transaction has the debit and the credit, and if you can memorize this chart, it all clicks together. So if you say, how do I record this type of transaction? You can think, okay, well, that's income. So I got income, so there's that. So then what's the other side? It's got to be something here. So is it money that I'm getting? Is it an adjusting entry? Is it a liability that's being decreased, or what? You can kind of start to fill in the blanks of the transaction. The last screen that we have here is accounts receivable, which is, again, money that is owed to you, but you haven't received yet. So in here, you'd create an invoice. So this receivable account is an asset account. So I'm increasing an asset. And with a receivable, you're basically saying, hey, so-and-so, you owe me money. You haven't paid me yet, but that's considered income for you. So I'm increasing my asset and I'm increasing my expense. So then when you receive your payment, this one's a little different. When you receive your payment, so now let's say somebody paid you the $100 that is owed to you, you're actually going to decrease your accounts receivable asset, and you're going to increase your cash asset. So it's a journal entry between the same types of accounts, but notice that the debit and the credit is still present, okay? Alrighty. Well, let's run through a couple of other examples here for journal entry, just so you can kind of see how it's done, and then we'll open it up for some Q&A time. So we've got contributions, so let's do another expense. So let's say I paid the cleaners, okay? Paid the cleaners. So I'm going to record down here. Actually, you know what? Take that back. I'm going to record that I bought a computer with my credit card. Cool. Okay, so I bought a computer with my credit card. So let's do the credit card first. I'm going to scroll down here, and I'm going to pick my credit card liability account, and I'm adding a value to my credit card. I owe money to my credit card, so I'm going to add a credit value to my liability account. So let's say it was $1,000. So there's the credit. So now what is my debit side? I bought a computer, so this is going to be some sort of expense account. So I'm going to scroll down here and find maybe equipment, or there we go, office equipment. So I'm going to pick that, and I'm going to enter the same $1,000 because the debits increase my expense accounts. Where'd that go? Here we go. Expenses. So there you go. So there's the $1,000 for the expense for the computer. Here's also the $1,000 that I now owe for the liability. So then everything is in balance. I click post. That now saves. So now what if I want to pay that credit card off? I would go in here and start a new journal entry, paying off credit card. I would pick that same credit card account. There we go. And now that I'm removing value, my credit card is being decreased. So what am I going to do? I'm going to enter a debit value because that decreases my liability account. So $1,000. There we go. So now I need a credit. So I'm paying this credit card with what? Cash, savings, petty cash? What am I doing? Let's say it's checking. So I'd pick my checking account, same fund. I'm going to enter $1,000 for the credit side because credits decrease assets. There you go. So there's my decretion of my, I don't know if decretion is a word. Might be. Here's me decreasing my cash account of checking, and then I'm decreasing the amount that I owe on my liability. Both debits and credits equal to 1,000. Everything is in balance, so I can now click post. So there you go. So that's journal entry. It is the standard, again, double entry accounting entry form in Aplos. Any accounting software that you're going to use is going to have some variation of this journal entry screen to where you can put in the account and the debit and the credit. The debits will always equal the credits. And then if you could memorize this chart, this tells you how each of your accounts works with one another to either add value or take away value based on a transaction.